Hi, everyone. I'm Mike Hirschberg, the director of the Vertical Flight Society. Thanks for joining us today. We have an all-star panel prepared for you to give you some insights into investing in the electric VTOL or advanced air mobility space. So Vertical Flight Society has been leading vertical flight efforts and eVTOL efforts for 6 or 8 years now. We've done a lot of different conferences, talks, and things like that, and we have a lot of innovators, a lot of innovative companies, a lot of innovative people in our memberships. Our corporate membership has more than doubled in the last 5 or 6 years. We're just shy of 150 corporate members now, and just January 2 years ago we had 100 members, so a 50% increase just in the last 25, 26 months here. So a lot of people, a lot of companies with a lot of innovative technologies, and a lot of money is now available and is being invested in vertical flight. So we thought it would be useful to have this series to better familiarize people with the investing landscape, the basics, to make sure that everybody understands the opportunities available. And we're really hoping that we can provide some through this series and some other events, provide some more contacts and hopefully increase the amount of money that's available and going into vertical flight developments, particularly for our members. As mentioned, we've got a great panel today, and the primary part of the lesson, if you want, is going to be provided by Rafferty Jackson. So Rafferty has taken companies through hypergrowth, investments, global expansion, through mergers and acquisitions and initial public offerings, including the sale of Beats by Dr. Dre to Apple for $3 billion. So she knows her stuff. At Jack Industries, she helps founders and leaders with strategic and transformation projects, mentors new space startups at the Seraphim Capital Space Accelerator, advises Zona Space Systems and New Vista Special Acquisition Corporation, which is where Kirsten Bartok Touw is, and invests in women-founded and led companies through Asia Angels. So she's going to give the primary lesson, and then focused on advanced air mobility and eVTOL will be Kirsten Bartok Touw. So she's also been an active early stage investor in new and emerging advanced air mobility technologies through Air Finance's venture capital arm. She's sourced, diligenced, and executed early stage investments in a number of relevant technologies. She's also an investor to, she's also an advisor to many AAM startups and a frequent speaker at the intersection of AAM and finance, including at many VFS events in the past. So our moderator today is Dana Jensen. He works for Gemini as the Senior Industrial Policy Analyst for Aviation in the U.S. Air Force Office of Commercial and Economic Analysis, or OCEA. He was previously at the Department of Defense Office of Industrial Policy, where he led DoD's Committee on Foreign Investment in the United States, or CFIUS, and the Non-Notified Transactions Unit. Previously, Dana worked on political military affairs with the Department of State and as an equity derivatives trader with BlackRock and BNP Paribas. Okay, there we go. All right, over to the expert, Dana. Thank you.
Well, Mike, thank you very much, to you and Jim and the rest of the team at VFS for putting this together. I think it's very timely, and hopefully it'll be as informative and as entertaining as we hope. I just wanted to lay a little bit of background before we move on to the real subject matter experts today. And so next slide, please. One thing to highlight is part of the reason for this session is that we get a lot of outreach from startups who see stories in the news about the, big valuations for some firms in the industry and the amount of venture capital that's flowing lately. And there's a real palpable fear of missing out, right? And so one of the things we want to do with these sessions is kind of level set for all of you, kind of give you the tools to realize kind of where you are in the funding process, whether you've raised money in the past or not, and kind of give you a sense of the scale and the level of maturity that your firm needs to have to undertake, funding at various levels, and kind of what are the key concerns, what are the upsides, what are the pitfalls, what are the things to consider when you're working with investors. And so one of the things I wanted to highlight here is just, despite the COVID pandemic, last quarter, the first quarter of 2021, there was $62 billion of venture capital flowing, right? And that's a historic high. So even though, the economy as a whole is in a kind of in question, I mean, it's doing well, but I mean, VC has really boomed during this time. One thing I'll point out, though, is if you look at the number of deals in the last quarter, 1,735 versus 1,657 the quarter before, those are not that divergent in terms of the number of deals, but the size of the money moving is much bigger, right? And so that's indicative of the fact that there are more big deals, which is to say late stage deals for companies that are relatively mature and potentially contemplating going public. So, you always want to look not at just the count, but also of the amount of money that's flowing, because it gives you a sense kind of where in the cycle the money is flowing. And lately that trend has been favoring late stage investment. Next slide, please. This is just a little bit more background. So, since we're talking about advanced air mobility, I thought I would, the numbers I showed in the last slide were for the industry as a whole, meaning industry as a whole. This is more specific to AAM, and what we did basically was use data that we collected through RFIs, through NASA and the Air Force, and collated them together to come up with a cohort of about 400 firms that either are or aspire to be members of the advanced air mobility supply chain. And so you can see here, out of that membership, 47 of them are public companies, but the vast majority, 87%, are private companies. And that's not unusual. I think in the broader market, you're still going to look at the vast majority of firms being private. That says a few things about transparency, because private companies don't necessarily have to disclose much about their investment activity. So a lot of times the data sets that you see in the commercial space, in the open source, are not necessarily very complete. But I don't think it should surprise anybody that, almost a third of these companies are less than 5 years old. If you look at the histogram there in the lower left, you can see the founding dates, by year. It's a young industry. I mean, there are legacy, sort of tier one traditional aerospace firms, which are the ones that'll range back into the 50s and even earlier. I cut it off at 1950, but there are some firms that were technically founded in the 1800s that are involved in this stuff. But they're large conglomerates. I'll also point out that the single most frequent source of financing for firms in our cohort here was actually CARES Act funding, Paycheck Protection Program funding. And that's good to see, right? It means that the money was flowing into our industry, but it also kind of it skews your analysis. So if you look in the middle graph there, the number of deals by date, that huge spike in March and April of last year is COVID money, right? CARES Act money. So, if we take that out, and it's a form of debt, right, which we can talk about later, but you can see that's a fourth order polynomial curve of investment counts, again, not amounts, into the supply chain for AAM. And you can see it's a good news story, right? I mean, it's been very resilient through here. And I think that's indicative of the level of enthusiasm that the market has for this in the longer term. So next slide, please. So this is a pie chart, again, of deal counts according to the various parts of the sort of chronological scale of VC that's out there. There are a couple things, and again, I'll leave this to Rafferty, who can really explain this, and we'll come back to this at the end, and it'll probably seem a lot clearer. But one thing I'd like to point out is, number one, M&A activity is a very frequent source of financing, and it's almost a fifth of firms have gone through M&A as their last funding transaction. Another is grants, and you can see that's 16%. But it's important to understand that that's a count of the number of grants. So if DoD is giving out a lot of very small grants, it'll show up here as a pretty big piece of the pie. But if you measure it by total dollar value, it's not not that significant in terms of moving the needle money-wise for the whole industry. So again, some of those are done through the Air Force, who I work for. but all grants, through whether it be the Department of Energy or anywhere else, Department of Transportation, also count in that. And then the last thing to point out is you see that yellow pie, the 12%. These are the firms that are on the cusp or contemplating potentially going public, and those are the ones that are closing these bigger VC deals that are contributing significantly to that eye-popping 62 billion from last quarter. So with that, I'll hand it off to Rafferty. You have the floor, ma'am, and please let us know what we need to know about VC.
Well, I'm really excited to be here today to talk to you all about these words that we keep hearing everywhere. And unless you've, for some reason, tripped into this industry, maybe you don't know what these words mean. My goal today is that you can take the pie that Dana just showed, and when it comes back on the screen at the end of my presentation, you'll have an idea of what all those terms mean and where all the money is going. And then you'll have a chance to hear from Kirsten and Dana as they talk about your particular industry. So let's put down our phones for a moment. Let's do some listening and some learning, and hopefully I can help you guys get ready to never show up on my radar when a venture capitalist calls me and says, inevitably I get one call a week, I have an amazing startup I want to invest in, but they have utterly screwed up their cap table. My goal is that you never come across my radar that way. The only way you come across my radar is we have an amazing startup we want to invest into, and they are so clean and thoughtful in the way they've raised capital. I'm really excited for you to meet them. So if we get started here, we're going to talk about first the basic type of investors. Not all investors are the same. They play in different arenas. They have different purposes for what they're doing, and they have different goals. So you have to be mindful as you're meeting everybody that you understand exactly who you're talking to and at what company stage you're about. Next slide. The first group of people we're going to talk about are angels. That's where I personally play, along with my husband. We are OCEA angels. That means we belong to a group that's about 20 years old that invests in women-founded and led companies out of Silicon Valley. As angels, the value that we bring is we tend to support the founder. So it's a very one-on-one relationship because the company is very small. It's usually the founders plus 2, 3, 4 other people. It's very quick diligence, easy for us to figure out, do we think it's a good idea? Do we want to fund them? The cons, though, are very small amounts of money. Average angel investments are $10,000, $15,000. So you need to line up quite a few angels if you're trying to get up to $100,000 or $150,000. The other con is a lot of angels don't know institutional investors. So if you know you need to go to manufacturing for a $100 million raise 5, 6, 7 years from now, your angels are very unlikely to have that network. They tend to be networked into the front of the ecosystem. So for example, I'm an ASTIA angel. I'm also a mentor at a new space accelerator out of London, Seraphim Capital Space Accelerator. That is all on the very front tip end of an ecosystem. Let's go on to the next investors. Next slide. Those are the venture capitalists. Boy, do they have money. If you took a moment to understand that Dana was talking about B billions, that's the kind of money we're talking about just in single funds. Some VCs have funds that are $1 billion big, just their one fund. Tons of money, and they are experts at helping your company get ready for an exit on the public market or a sale. The con of a VC that you have to be aware of is the founder is not the customer. The customer are the LPs. So how a VC operates is they create a fund and they go out and find limited partners who give them money to go into the fund. Once that money is in the fund, the VC and the limited partners, the LPs, make a deal. It's always in writing. It has to do with the exact kind of fund, who the VC is going to invest into, and then what the exit time frame is. LPs are looking for money back on a time frame, 5 years, 7 years, 10 years. So the VC is always looking for companies that fit that parameter. For example, if you think you have an exit 20 years from now, because of regulatory materials, a lot of VCs are going to say, we're not interested in meeting with you. Has nothing to do with your company, has nothing to do with the value that you're bringing. It has to do specifically with the fund documents between the VC and the LP. The other side of VCs that can be difficult is they can be very aggressive and controlling if you come off plan. So if your plan was to be exiting, mature in about 7 years, and something starts happening to your business that looks wonky, you may see them step in and exercise some investment rights to take control of the company to keep it on the track, because their LP is the customer, not you, the founder. So that's what they're keeping their eye on. Next slide. Family offices. This is something to really keep your eye on because it's starting to get a lot of attention. We recently had a failure here in the United States of basically a family office that has caused leaders at Credit Suisse to get fired. That's how much money is in the family offices. So a family office is actually what it sounds like. It's personal family money that is of such a magnitude that they have hired employees to run a company that invests the money. Here's a great example. If any of you guys are fans of Taylor Swift and you've been following her fight to try to get control of her recording rights, right now, Shamrock holds her recording rights. Shamrock is the family office of Roy E. Disney, the son of the Roy Disney who co-founded Disney with his brother Walt. It's a family office that holds those rights right now. Family offices tend to be somewhere between an angel and a VC, obviously a whole lot more money than most angels. The con is they can sometimes be really unstructured, difficult to hold them to timelines because they're mission driven, specific back to that family. So when you engage with a family office, the trick is to try to engage above the employees at the family office and make sure you're to the actual family, which is difficult to do, but that's sort of my trick if you're going to get in there. And they too might be really unlikely to know institutional investors. Sometimes they tend to be on the upper age range and their connections are on the upper age range when the decision makers might be more like in their, the next generation down in a company. So you have to be careful about conversations that say, oh, if you come into my family office, I definitely guarantee you can get to so-and-so, because that might have been true 20 years ago, might not be true today. Next slide. Next thing we're going to talk about is incubators and accelerators. So a lot of folks forget that these are investors. It's really important to put this into your landscape. An incubator takes a much earlier idea. So maybe it's just the founder, piece of paper, has something, maybe it's straight out of academia. They actually help you incubate the idea. So get legs around it. Is it a real idea? Do some of the market matching, get you some product people to look at it. And they help you figure out if you have a company. In theory, when you come out of an incubator, you should be in a pretty clear, yes, I have a company. No, I don't have a company. And how I like to think about it is, yes, I have a product, a real product that market matches. Oh, I really only had a feature. I only really had something slightly interesting, but not enough to build a whole company. Accelerators take that company that's early, you've got the idea, you've got a few people, and they quote unquote accelerate it by getting you access to people you could never get access to on your own. So you might have a marketing meeting with the CMO of Citibank, right? It might be a meeting that there is no way you could ever get there, but the accelerator matches you into an extraordinary network of experts who lean in for an hour or two, really give you their point of view, and then it's your job to take it away. There's a lot of pros. They support the founder emotionally. You can have complete breakdowns in incubators and accelerators, and it will never touch you as far as your business goes. So it's a chance to emotionally mature. I always say it's the chance to get blisters and calluses, which is really important to coming into the marketplace. Great training, great networks. The con is the quality and value vary dramatically. You have to be very careful about who you're engaging with. And you have to be very thoughtful about running references. Make sure you are talking to other people that have come out of that program. Don't talk to the references the incubator accelerator gives you. Look up the companies that came through it that aren't on the reference list and make sure that it's really a high quality experience. The challenge you can have is what's called dead equity. They take a position in your company as part of their trade to give you all the support for this time frame you're in the incubator accelerator. And they are always on your cap table, but they may be what we call dead equity. They're holding a position, but they're driving zero value into your company. They have not really helped you. They didn't really get you the connections they promised. When you're calling them, they're not calling you back. So be really careful about who you go into an incubator accelerator with, especially if there's equity involved because of this dead equity problem. Next slide. Strategics. We love strategics. So strategics are the people who are already in the marketplace, already have a company, and are already in your space. Adjacent, or maybe somebody who could launch your platform. So if you think about a traditional strategic, you would think of Google Ventures. So Google obviously is the company. Google Ventures is the venture wing within Google that invests in startups. Another example would be Boeing's Horizon X, right? So Horizon X, Boeing, they funded Horizon X, they go out and invest in startups. There's a ton of pros on this. They know your business. If they come in and invest in you, it's a signal to the whole marketplace that you're for real and that you get it. And they're like-minded. They tend to really understand it. The cons are they can be slow moving and process driven, right? So yeah, you can be a VC within a big company, but you're still going through that big company approval process, and the timelines can be staggering to try to get that investment. So you have to be mindful of engaging and how you engage. The other side of it is you're getting in bed with your competitor possibly, right? So you have to be mindful of the fact that these are the people you're going to compete against possibly. There can be some trade secrets problems with what you want to talk about with them. So strategics come later in your process because it takes more maturity as a business person to probably interact with them. But they can be a real superhero investment that can really make the company go. And then the last group we're going to cover, next slide, is the crowdfunding. So crowdfunding has become very popular, and it's also something that the SEC is very keen to get involved in and help with. Crowdfunding allows the public to come into these other areas that you just looked at, angels, VCs, family offices. It allows the public to come in and participate into these pre-public companies. So it's pretty exciting because the average person doesn't usually have the choice to move their, $500 or $1,000, $50, whatever it is, into one of these companies and try to ride it along for the whole success. That's something that's not usually available to the public. The exciting thing about crowdfunding is usually you're not having to give up equity. So for the founder, it's a great way to get money into the company in exchange for something. You're usually giving an advanced review of your product, some access to something. The other thing that's terrific about crowdfunding is, depending on your company, there's a good chance whoever's crowdfunding you is going to be your actual end user customer if you're going into some sort of consumer space. So you get a chance to start building your customer database straight into your customer, your CRM. Here are the cons though. You can really get a shine when you go out for real investing that you couldn't get funded. There's this catch in crowdfunding that if you crowdfunded, a lot of investors will look at that and say, oof, that means you couldn't come to the real, quote unquote, real market of investors and get your idea validated. So you have to be really careful about how you manage that shine that can get cast across you. The other challenge is if you are doing a crowdfunding where you give the people who are crowdfunding you advanced technology, so an advanced prototype, an advanced look at your product, they will hammer you in social media if they don't like it. And you can really get into a very bad situation where what you think of as your alpha product, or maybe even a prototype product, is all of a sudden appearing to be the final MVP and out in the marketplace and getting destroyed. So you have to be really careful about how you manage through that. All right, next slide. So those are the basics of investors. There are a lot more investors, but those are the terms that I think you guys will hear the most. So I just wanted to make sure you at least understood the basics there. Let's now go over to the basic types of funding. And just like with investors, all funding is not created equal. Each round of funding has a specific purpose. It happens at a specific moment in time in the company life cycle, and it is very dependent on where the company is and where the market is at that moment in time. So next slide. These are the basics of what the terms are you're going to hear. These are rounds of money that have come into an enterprise. So we have the pre-seed, seed, Series A, Series B, Series C, and it'll keep going if you have a large infrastructure. You'll see a C, D, E, F, G. You've seen up to Gs before. And then you have, in theory, an exit through going public on a stock exchange. So an IPO, an initial public offering. This is the chart for today. I can tell you now that this chart would look different 10 years ago because you wouldn't have had pre-seed on there. 20 years ago, you wouldn't have had seed on there. And as we go through this presentation today, you'll see I've got a whole new pillar on something called SPACs because that's changing what the market is doing. Next slide. You guys are also going to hear something called a bridge to. So if you're out in the market and somebody says, oh, right now we're raising a bridge to C or a bridge to B, what that means is that they're not quite ready to go full on into the next raise. So here I've got a bridge between A and B. They're lining up the investors for B. They're doing the presentations. Maybe they're looking for a lead investor. They're trying to figure out, are they going to raise 30 million, 50 million? They're working on some basics, but they're in motion. But what they can see is that they're going to start to have a short runway of cash to get to the B. So what they do is a bridge. They go back to their A investors, the Series A investors, and say, will you bridge us to this next Series B? The bridge can take all sorts of forms. It can be the exact same terms as the Series A. It can be a note that basically turns, I give them money to get to the Series B happens, they actually pay me back that note. So that's what a bridge to is. Next slide. The other words are here is follow on. And that's a little bit of, it goes another direction. A follow on to B means you're not, maybe B didn't get closed. You had a goal of 50 million getting raised. Maybe you got to like 35 million and you just decided we're going to close the 35 million. And yeah, we still have capacity for the 15 million and I want to raise it. But right now I'm going to take this 35 million and start building. A follow on is where you look back at that Series B and say, I still had 15 million there. Maybe I'll go see if I can get a follow on and somebody to take that 15 million so the Series B is complete. And then next slide, the last thing everybody needs to keep in mind, and Dana already tipped his hat to this, is you can get acquired at any moment in time, anywhere along this continuum. There's no moment in time where you can get acquired. It has to do with the acquiring company and where you are on your roadmap versus where they need a hole filled on their roadmap. So anywhere along here, you can see an acquisition. Let's go ahead and take a look at each one of these legs of investment, and we're going to look at the average range of investment, the typical company valuation, investor type, company stage, and the use of proceeds. So next slide. If you're looking at pre-seed, and this is where at Asti Angels, my husband and I tend to sit, is in the pre-seed and in the C round. The amount of total investment, not from one angel, but I mean in total, all the money lumped up and going into the bank account of the company is usually less than $1 million. The company valuation pre-money is about 1 million to 3 million. So you guys can see this is really early. This is an idea, but it's an idea that's pre-product. You can see that in the company stage. The investor types are who we just talked about. We see angels, right? And you guys see accelerators and crowdfunding. But let's talk about friends and family. Your friends and your family are literally who probably stands up your pre-seed. And I do mean your friends and your family. I mean your Uncle Bob and your Aunt Sally, and I mean your college roommates. Your friends and family, they're people that believe in you, hope you have a good idea. They may not necessarily know your industry. Sometimes you'll hear friends and families and angels talked about the same. I see them very different, although their money is the same in the sense that they're playing in the same rounds and for about the same amount of money, $10,000, $5,000, $15,000, $25,000. Friends and family tend to invest in you as a human being. They've known you since you were a kid. They believe in you. They believe in your idea. Angels tend to run a portfolio. So for example, in my portfolio, I have my companies, I'm following them. Every year I allocate how much I'm going to invest against new companies or how much I have to invest into these companies to get them to move to the next level. Your friends and family might only ever invest in you. So that might be your only investment. Some of our greatest companies are friends and families birthed companies. So Bill Gates' dad investing in him. So friends and family, don't ignore, they're really important. They're probably, in my mind, friends and family, and then your credit card, lines of credit, and loans are probably the biggest chunk of money that's actually flowing into companies, although I don't have a pie chart for that. That's just my gut feeling. That's probably how we stand up most of our startups. You take the money and they're probably going to have to hire somebody and you're going to try to start developing your product. So next slide. Seed. Seed is also where you'll see, if we go to investor type, same, friends and family, accelerators, crowdfunding, angels. This is where you might see early stage. That means, you know, in our chart where we were going left to right, pre-seed to IPO, early on the left of the chart, early stage venture capitalists. This was not a thing until maybe 10 years ago. Venture capital did not do deals with their limited partners to take this much risk and come in this early to the ecosystem. The risk that venture capitalists used to take is the company's standing up, they've got product, they've got a team, all they need is cash. So that's more like Series B, C, D. They are now pushing into the seed rounds and the pre-seed rounds. So you'll start to see early stage venture capitalists. That means they've created a fund where they went to the LPs, the limited partners, and said, we want to take more risk earlier in the ecosystem to get a higher return. Are you willing to put your money into this fund? And that fund will be tagged as early stage. The amount of investment, 150 to 1.5 million. Typical valuation of the company before the money's in is 3 to 6 million. Usually you have signs of product market fit and traction. You've got something happening outside the company saying this is an idea. So it could be like Dana had mentioned, a grant. It could be something where there's a marking of the market saying, hey, oh, we think this is real. The use of the proceeds go to fueling beyond the funding, which means if you took in 500,000, in theory, you're going to be able to grow more than 500,000 value into the company. So you're going to have your post money, plus you're going to bring more value. Next one. Series A. Series A is pretty exciting because if you're starting to hit Series A, that's where, you know, you're really starting to get up into the like, woof, you got a company, you got something going on. Your investment is 1 to 15 million. Typical company valuation before that investment is 10 to 15 million for the enterprise. I think that's a little low, but this is from Crunchbase, and this is from kind of the book of all books, from pre-seed to Series C, the startup funding rounds explained by Ryan Law. Investor type is super angels. Personally, I have never met a super angel. I know they exist. I think they're probably, I don't know, Kirsten or Dana might be able to comment on that when we get to the rounds, but that super angels are out there. Family offices tend to come in right here. And the reason why you see a family office here is a Series A ready company has been getting press. They've been able to get some customers, and they're firming up what is the problem they're going to solve. If that problem solution lines up to what that family office is really interested in, you'll see the family office want to come in and try to fund it. Traditional venture capitalists. This is where you get the traditional money coming from, you know, now all over the world coming in through the venture capitalists. Company stage is revenue growth and customer acquisition. So the Series A companies have solved, you know, who are they selling to? They might still be working on how much are they going to charge. They might still be working on what's the total product to be delivered. The use of the proceeds almost always at Series A has to go into sales and marketing. At this point, you've probably done a lot of your product development. Of course, a lot of it's going to go into engineering, but some of it has to start peeling off to get sales and marketing going and customer insights going. Next slide. All right, Series B, you're at 5 to 35 million in investment. Your typical valuation is 30 to 60 million. Family office, venture capitalists. This is where you tend to see the strategics come in. You have survived. You have made it to this point. You have been meeting with your strategics for a while now, as a customer possibly, or somebody in your supply chain. And this is that moment in time where this important relationship can convert from customer to investor. You are at the scaling point of your company stage, and you're going to spend some money getting very expensive, seasoned 20-plus veterans, 20-year veterans to come in and run and build a lot of the aspects of your company. You're going to be looking at new market segments and revenue. And then let's go to Series C plus. The next slide. This is the big ones. So now you're talking about the massive infrastructure builds. If you're on the 20 million, that's more like app building. But if you're on the 300 million, you're probably trying to launch a satellite constellation. You're trying to do something big. Typical valuation is 100 million to 120 million. Again, that seems light, but this is from the sources that would know the overall data. This is the late stage venture capitalists, opposite of early stage. The particular fund on late stage says we want to take investments and make them big. Sovereign wealth funds come in here. Kirsten will be talking a little bit about that. Private equity, strategics, hedge funds, and banks. Large scale operations, and you are moving. You are a full-fledged company, and you are ready, next slide, to go public. When you go public, it's a liquidity event. Your investors get their money back. That's the whole reason they gave you their money. They didn't do it because they are nonprofits. They did it to make money. And what they're hoping is whatever dollar they gave you along their path has turned into a lot more dollars. That's the ultimate goal. Your investors on this point are obviously, now you're in the market. So you've got your investors of the primary and the secondary. You're supposed to be profitable, but we've seen that change. Uber, Airbnb, Snap are exceptions. They're not profitable and they went public. You are public company compliant though. It means you've got audited financials, you've got all the regulatory, all that good stuff. And right now you're going to go global. That's the goal. So next slide. What are SPACs? How do they fit in? So SPACs are really interesting. So next slide. We had our original pathway, right? So you're clunking along, doing your pre-seed seed, you're marching along. What a SPAC does is it is a publicly traded financial only organization. It has no operations or product. It goes public and it raises money with a promise to those shareholders in which the SPAC says, we will find a company to operate, to merge into and bring them to the public market in our shoes. Next slide. So what they do is they hijack in one hop all of that other fundraising. The SPAC has gone out and raised the money with this IPO and said, we don't own anything, we don't do anything. We're holding this cash in trust. But what we're going to do is find a great company and we're going to give them all this cash, take them off of having to raise the Series B, the C, the D, the E, whatever's left on their pathway, and they are going to step into our shoes on that public market with all this cash, and now they're going to operate. So if you look at like Virgin Galactic, for example, the SPAC had a holding place of IPOA on the stock exchange. It had raised money and made a promise. We don't make anything, we don't do anything, we hold this cash, but we're going to find a company to take over this cash and our position on the stock exchange and go public. And so Virgin Galactic, that stock ticker went from IPOA to Virgin Galactic's ticker of SPCE. And now it's an operating public company. Next slide. This was what we just covered, the traditional IPO. Next slide. This is what it looks like when you go via SPAC. The type of investment is the SPAC IPO's money. So that's an IPO that they did plus a pipe. And then if you look at the company stage, it has really changed. So now it could be a Series B company. They could just be at the point where they were getting ready to scale. The big challenge, though, is they have to be publicly compliant the minute they step into that stock exchange. So yes, you were able to give them all that money, but they also have to take on the mantle of all that compliance. The use of proceeds could be all the way back to what they're doing in Series B, right? You could be having to hire people. You could be still looking for your revenue streams. You could be on your large scale operations. You could still be looking for market match. But that is how you end up with SPACs coming into this entire chain. So next slide. I have 3 quick commandments. Number 1, next slide. You spend all this time sweating your idea, your names, your colors, your customers, your location, employees, and then you give your equity away like a drunken sailor. The goal is for the founder to always have control of the company, 50.1% of the cap table. If you take in 5 rounds of funding, pre-seed, seed, A, B, and C, and you're getting diluted every round, you are going to lose control of your company on a percentage basis. There are easy ways to mitigate this as long as you are serious now and you learn about how to build your cap table. Watch out for debt equity. That's granting equity without vesting and the person disappears, right? Watch your burn rate like a hawk. So try not to run out of money. Make sure you're lining up your next financings, because what you don't want to do is trade your cap table like it's a hostage. You want to be serious about your cap table and always maintaining it. And also try to avoid a whole bunch of little teeny holders on your cap table. When you get serious about your fundraising, each one of those people might have to sign a document. They might have to be researched for citizenship. They might have to be researched for net worth and criminal record. All of these issues are easy to mitigate. Everything's out on the internet. Just be serious about it. Next slide. Number 2, non-dilutive funding is always the winner. Always, always, always. That means revenue. If you can get to revenue, take the revenue. That means grants. If it's a high quality grant, take the high quality grant. Anything you can do to bring in non-dilutive funding means you are always defending your cap table against dilution by creating a higher valuation in the company. That's how that balance works. If you do not want to sell your baby and you do not want to go public and have analysts and short sellers and a board of directors and pension funds consuming your time, don't take any equity money. Use your credit card, your loans, crowdfunding, grants, and revenue. And the final thought I'd have for you guys is, next slide, pick the highest quality dollar. All money is not the same. The better quality dollar brings you better networks, better connections for your next level of financing, better C-suite connections and customers and experience. It can be the 2 + 2 = 5 that you need to be successful. Foreign investors create a lot of compliance issues in the United States. They can be amazing for your business. Just make sure you understand your risks and rewards by talking to experts. And then finally, investors who don't understand your business can cause more trouble than they are worth if they become active. Beware the rich bored investor who wants to get quote unquote involved in your new and exciting industry. Date every source of fund like you would have dated your future spouse or your future co-founder. Be slow and steady and thoughtful and be serious. So hopefully this has helped, gives you guys an overview, and we can now go back to Dana's pie charts, and hopefully this will all be something that will make that pie chart make a whole lot more sense. Thanks for listening.
Okay, so here we are back at the pie chart. You can see the seed round and the angel investors, that's 14% of the total. And again, as you would imagine, activity picks up when you start getting into the Series A and the later stuff. The grants, like we said before, non-dilutive, helpful as a signal to the market that at least someone did some due diligence on you and found what you were doing compelling. I would, put a plug in here for the stuff that the Air Force is doing with AFWorks and through AF Ventures, and also the Department of Energy, if you're involved especially in propulsion systems or energy storage, ARPA-E is a very active grant originator for people who are working in that space. And in fact, they just kicked off a new program on January 20th or something like that. So I would definitely look at them. You can see the accelerators play a relatively strong role. I mean, at 10%. And again, you know, that's dilutive. They're going to be taking 5% or 7% for, you know, a $50,000 stake or something like that. They all have their own parameters. But the beauty of the incubator in particular is you get out and they have a demo day for you where you get to get up on stage like a science fair and show what you've done to a bunch of savvy investors who they've invited. So you get a lot of exposure if you get into the right incubator. So I highly encourage you to look at those. And it wouldn't be hard to find a list of the top 5 or 10 incubators out there in terms of their track record. And if you can get your foot in the door there, that's a great way to go. With that, I'll turn the floor over to Kirsten here. If you have any thoughts here after what you've heard from Rafferty or from me, and otherwise we can take some questions.
There we go. Now I'm off mute. I think Rafferty and Dana gave you a great overview of the investing landscape. And one of the most important things and why incubators are so valuable is that you have an opportunity as a startup founder to ask questions. It is never wise to go into any meeting with an investor and ask them what a venture capitalist does or what a SPAC does or how that works. So you want to get, there are a landscape, and that's Dana and that is Rafferty, of wise advisors out there who can educate you and also test your pitch. Because one of the things that occurs early, which is a test of whether you're ready to raise capital and whether you're professional enough and you have a team in place, is how well you pitch. And there is an expectation at each stage. For example, as Rafferty went through, you know, your friends and family and angels will have different expectations for what a traditional institutional investor capital will. So incubators often give you an opportunity to hone that, to practice in front of investors and have real kind of testing the waters meetings of how you're received and are, and what type of questions investors will ask. Because the more prepared you are, the more likely you are to raise capital. So I'll kind of leave it at that. And I think now we're going to take an opportunity for people to ask questions for the last 10 minutes of our conversation. Is that correct, Dana?
Yeah, so I've been keeping an eye on the question board so far. There are a couple questions about SPACs. A lot of them center around how they're structured in order to kind of minimize or attenuate the volatility of the stock once it hits the public market. What are the guardrails, so to speak, in terms of, you know, lockups or other earnouts and provisions where, you know, a SPAC may look like a kind of a rash move, but when you look at the way it's actually structured, it is, you know, it does maintain that sort of longer time horizon that's necessary for something like AAM development. So could you maybe speak to kind of how SPACs are structured to kind of mitigate that volatility? Sure.
I think the most important thing about a SPAC is that your company needs to be prepared to be a public entity. We were talking with some of our SPACs investors, I'd say just yesterday, and they were talking about how often when a company goes public by a SPAC that they don't have any investor relations in play, any organization to handle investor questions. So that highlights one of the problems that, say, companies who are going public too early might not be prepared. Then if you do not have a system in place, if you do not have public company accounting in place, if you do not have a plan for investor relations, again, you are increasing the volatility around your stock. Typically, how the lockups work is in some cases, and some of this depends on how positive a market is. For example, there have been times over the last few months where the trend was really in favor of companies going public by a SPAC, and then they cooled off. For example, there was a cool off period in the fall, and there's a bit of a cool off period happening right now where terms have gotten more difficult. But the typical is that you are the company's investors who are going public and gaining additional growth capital via the SPAC and the public, what we call a PIPE, so a private investment in a public entity. Typically, the shareholders are locked up for a period to 6 months to 5 years in some cases. I think the average is more 6 to 12 months. Some are longer, especially if investors have taken money off the table as part of the SPAC, which does happen occasionally. But they are locked up for a period of time after the company begins trading on the IPO. And typically, a SPAC is the investors in the SPAC are locked up about that, or the sponsors in a SPAC are locked up about the same time, or sometimes a bit longer. And in some cases, they have a hurdle of a price to meet. So the goal is to have everyone's incentives aligned and have both shareholders, management, and the SPAC all on the same page of how to help move the company forward and help accelerate their growth.
Excellent, excellent. Got a question here, actually more than one, about how VCs evaluate or value patent portfolios and other IP. What do they, you know, how do patents that have been granted or applied for factor into the valuation decision?
I think that's a great question. It's more validating. So having a strong patent or patent portfolio will never compensate for a weak management team or a weak business plan. So you need both of those things, but what a strong patent portfolio does is validate that this IP is yours, that you created it, and that you have a moat around and are able to defend it. And those three parts are extremely important, because as a VC will go in, they'll validate management, the quality of the management, quality of the business plan. They'll look at the total addressable market, which you'll often hear described as TAM, and they'll also look for a product fit. For example, is this something the consumer's market or business needs? Sometimes there are great technologies, but the VCs have always had a term, are the dogs going to be the dog's food? So you could be making something for technology's benefit without really having a consumer niche where there's someone, whether it's a business or a consumer on the other hand, who says, this is valuable and I will pay for it. There's been another problem over the years that we've seen, and again, the internet has shown this, is in a lot of cases, you can make something really cool, but people aren't ready to pay for it. And that is also a difficult quandary to be in, because you'll say, look, we released it and we have all these users, and then a VC will say, but they're not paying for it. So how can I see that this will be an opportunity to build a large company which has strong revenues and barriers to competitiveness? So I put all of those issues in there. So a patent portfolio is valuable, but you have to look at all the other things alongside that.
I have a question here talking about, is there a central way to get in touch with angel investors? Is there some sort of systematic way that people can do it? You know, if you're just starting out, obviously if you go through an incubator, you know, you've got access at the end of the program through demo days and things like that. But failing that, is there another way that another mechanism people use to get in contact with angel investors?
That's a great question. There have historically been two routes. Originally, there were networks of angels. This could be, for example, in the space sector, space angels, or there have been a lot of angel networks in regional areas. So let's say around a metropolitan area. So you can look that up and find that in your area. And those are really individual investors who want to participate and may pool their money and invest through you. There's also websites that do a bit out there now. The other area I would say is in the last, let's say, probably about 5 years, there have been an influx of a seed and angel kind of focused funds. So these are companies that really want to be the first capital into early stage companies. They tend to be very, very focused and targeted. So they have people who are likely entrepreneurs, that they're deep tech, they understand the area extremely well, the vertical, we should say, whether it's healthcare or fintech or advanced air mobility, that these people are very, very focused, and that those are good opportunities, and that they will kind of be your seed or Series A type investors. So that has been a trend, and in those places typically aren't, we talk about your Sequoia or your Kleiner Perkins, who are large firms with diversified groups. Kind of the seed venture funds tend to be one-off individuals. There are also other people out there. I just go back to the super angel comment that Rafferty made earlier. Ron Conway always kind of made his reputation be, he was one of the early investors in many, many companies like Google and the like, as being a super angel, where he would write a check for 100,000 or 200,000 or 500,000 in an earlier stage company. There are many groups out there that have emulated, or I should say individuals, who've emulated at Baseline Ventures, Steve Anderson, types like that, who've emulated that model. Now, again, a lot of them tend to be focused on certain areas and say, okay, we're internet or we're software focused. So they may not, a lot of the traditional Silicon Valley entrepreneurs don't like hardware, deep tech. But if I were you, I would look for places that speak about their affinity for deep tech, their affinity for hardware, and they understand it. There are quite a few funds out there that do focus on those areas, and those would be the places I would go to.
Excellent. One final question, and then we'll turn it back over to Mike for some closing remarks. But someone here is asking, who are, of all those investor categories, who's going to invest in infrastructure, right? Because infrastructure is such a hot topic lately, and it's not the kind of thing you would see an angel investor come in and do. So how exactly, what would the mechanics be behind getting infrastructure money?
That's a great question. So glad you asked it. So funny enough, there are infrastructure funds, and those are funds that tend to invest in hard assets, but they have a lower return on investment hurdle. So let's say a venture capitalist really wants to make, 25 to 30% IRR on their investment. These infrastructure funds, and they're called Macquarie, Oaktree has one. There's many across the country. That they tend to have hurdles that are more in the 11, 12, 13%, and that they like to be backed by hard assets. So whether it's an airport investor or a road investor, a toll booth, or they're building an airport, or even now a lot of them have gone into data centers. Those are the type of infrastructure investments. Real estate is often very akin to infrastructure. So if you're talking about airports, maybe it's a real estate fund that invests in that infrastructure, or it's an infrastructure fund. And then lastly, I think we are seeing additional focus from, let's say, sovereign governments who are saying, we will either through a sovereign fund, like you've got Saudi Arabia's PIFCO, or Singapore's Temasek, or Qatar, Ireland has one, Australia, the Future Fund has one. There are a lot of those that will invest in infrastructure. And maybe to your point, Dana, you mentioned the non-dilutive capital that is either coming from the Air Force or the DOE, or we'll see going forward who will invest in infrastructure that we need long-term to build out to have a strong business network.
Well, Kirsten, I just want to thank you again for taking the time. I think this was very beneficial for all of us. I know I learned a lot, and Rafferty as well. I think, just the pure nuts and bolts of how this works, nobody's better at that than you. So I really appreciate that. And Mike, if you want to hop in and offer any closing remarks here, we're about 2 minutes from the top of the hour.
Yeah, absolutely. Great. I mean, Dana, you said it. I mean, just a really fantastic talk. Thanks, Rafferty, Kirsten, and Dana. A lot of insights. I know for some people this was really basic stuff, but that's where we're going to start. We're going to start out basic. We're going to have a series of these webinars. Chris, if you could bring up the last slide there. We're going to have the next webinar will be on May 6th. We've got Michael Diamond, who's a principal at Nexa Capital Partners, and we'll have a couple other panelists speaking. We're looking at probably a monthly series or so, and we're hoping to build this education and initiative and momentum to go towards something like a pitch day or something where we can really make some good connections. This 101, this first talk was open to the public. The next series are going to be for members only. So if you're not a member of Vertical Flight Society, well, maybe after this question, are you really in vertical flight? So join the Vertical Flight Society. It's free access for members. We do want to continue moving forward. As I said, we've got 150 companies now, 6,000 members. We're really growing. We're trying to grow so we can support this industry moving forward. So the next one is, as you can see here, May 6th, on Thursday, same time. It's the week before our 77th annual forum. So if you really want to get a graduate level education on what's going on in vertical flight, everything from advanced rotorcraft to advanced air mobility, please go to our website, eVTOL.org, learn about the annual forum, and we hope to see you there. And thanks again to our panelists, and thanks for everybody for joining us. We have a lot of questions here that we didn't get to. We'll try and answer those in subsequent meetings, and again help the conversation moving and the education and reach that vision of advanced air mobility that we all want to get to. So thanks again.
Thank you. Good day.